The first speaker I'm going to introduce, so we've got each of three speakers who are going to come up, present, and then we'll have a Q&A session towards the end of the session. The first speaker I get to introduce is Helen Sinclair, who I've had the personal fortune to work with in her former capacity on the board of directors at TD Bank. So excited to have Helen here today. She is the founder and chief executive officer of BankWorks Trading, Inc., a provider of broadcast and webcast services for businesses. She is the former president of the Canadian Bankers Association. Ms. Sinclair holds an undergraduate degree from York University and a master's degree from the University of Toronto, both in economics. Helen is a graduate of the Advanced Management Program of the Harvard Business School and a corporate director since 1994, serving on the boards of EPCOR, the St. Michael's Hospital Foundation, and was a past director of TD Bank Group, the Canadian Pension Investment Board, Transat, and Stelco, among others. Please give a very warm welcome to Helen.
Thank you, Chris. It was wonderful to see you as the moderator today and have a chance to reconnect. And hello, everyone. I may be an economist by training, but I'm not a historian. And what you're going to get today is something that doesn't respond to the rigors of business history. It's more an account of a career that stretched across the banking industry, including the Bank of Nova Scotia, the TD, and the Canadian Bankers Association. What I want to do is the following. I have 6 major topics to cover, and there are a couple of others which I'm leaving out, partly because I think Robert will cover one of them, and partly because I don't have enough time. So here's the flow. The flow is to remind everyone that the genesis of the chartered banks was in trade, therefore not strictly in a domestic market. Secondly, it's to take you through not just the domestic piece, but to remind everyone that we got to the domestic state we're in from being local banks in the first place to then branching across the country, and from going from plain vanilla providers to universal providers. So it was a long journey, and I'd like to just take us through it briefly. I want to step back from that journey and cover a small, rather unpleasant interlude, albeit one that saw us back in global markets, and that was in the 1970s when we got involved in Euro business and we flushed the deposits we were gathering in the Euro markets into sovereign accounts with the less developed countries. It did not end well, and there were many lessons to be learned. And then I want to go back to the 2 catalytic events, which I think, if not the root causes of the bank's move to global in the last few years, at least it was they were a call to action, and I think they did have an impact at a particular point in time. And then I want to finish just reminding us all that while in the oligopolistic Canadian market everybody kind of looks the same, every single bank will deny it, but most people on the street say every single bank looks the same. In the global marketplace, everybody is different. And I'll just cover off 3 of the banks to make the point, because I don't have time to do it all. I'll refer to the Scotia, I'll refer to the TD, and to the Royal. So let's just go back to the genesis was in trade. Robert, I know you're going to refer to the excellent, I think, Calamaris and Haber book for Fragile by Design, but it's an interesting book for anybody who hasn't read it, because it really explicitly reminds us that the challenge of the chartered banks in this country was not to move goods, as was the case in the U.S., from one metropolitan center to the next, but to take commodities that were in the hinterland and move them across vast expanses, trouble-free, hopefully, across the ocean to Europe. That was the genesis, and that, of course, led to an expertise, inevitable expertise, in a number of areas of banking, which today we would say are part of the global portfolio. It included trade finance, it included promissory notes, it included foreign exchange, very important today. So that was the beginning. Interestingly, two of the banks, the first one, Bank of Montreal, and close on its heels, the Commerce, took that expertise into the U.S. market very early on in their existence. Not so early for the BMO, but very early for the CIBC. The Bank of Montreal went to the New York and Chicago markets in the 1860s and provided very sophisticated services that the American banks were not in a position to provide. They did gold trading on the Civil War and Reconstruction markets. And to some extent, there was a little bit of chafing back in Canada because people said at that time, we're talking 1860s, they're withdrawing from their home market, they're withdrawing from retail. And in fact, one of their directors, McMaster, resigned from the bank on that basis, founded the Bank of Commerce, and promptly went and did the same thing all over again, moved into the U.S. market, but in this case, servicing the cotton trade with offices in New York and New Orleans. They became the principal bankers to the U.S. government in the Philippines after the Spanish-American War. And by the way, for a substantial period of time, the Bank of Montreal was the largest bank operating in the United States. Now, clearly the growth in the U.S. banking system overtook them, but that was the beginning. And you see that beginning replay itself later on in the lives of the banks. So the BNS, and I call it BNS still because that's what I call it when I was there, it's called the Scotia. And what was then the Merchants Bank of Halifax, later on the Royal Bank, went a bit of a different route. They didn't go quite so early, but they looked at the trade triangle they were looking at was east coast of Canada, Caribbean, Great Britain. And so they were moving and trade financing the sugar trade for the most part, but a bunch of commodities in one direction and consumer goods in the other direction. And they went in there in the 80s and 90s. And it was always a big point of pride when I was at the Bank of Nova Scotia that they had established a branch in Kingston, Jamaica, 8 years before they opened a branch in Toronto. So that became very much part of their gestalt. So in 1908, there were 50 outposts of the Canadian banks, the chartered banks. There were 5 in Newfoundland, 3 in London, 1 in France, 1 in Mexico, 16 in the United States, and 24 in the Caribbean. So clearly what had happened in the Caribbean is that it went beyond a trade finance operation to the build-out of banking services for the local population. The build-out continued into the 20th century, I think more so in the case of the Scotia than the Royal. The Royal says that by the end of the First World War, their Caribbean network was pretty mature. They moved into South America and other markets. They actually, at the end of World War I, established an office in Vladivostok, which kind of got my attention. And what they were doing was servicing Canadian merchants and the expeditionary forces and British troops that were withdrawing from Siberia. They say that branch didn't pan out the way they expected, and they ultimately closed. I'm not sure what that was all about. They then they pulled back a little bit during the Great Depression. The Scotia seems to have pushed forward, not with the same speed, and in 1933, in the pit of the Great Depression, Scotia made the claim that it was proportionately more international than any other chartered Canadian bank. Their expansion continued in the 50s in those same markets, but fair to say by then end of the war, we're getting to the baby boom growth spurt in the country, the real engine of growth had shifted to Canada. And so let me go into my second piece, which is a bit of an account of how we went from being local to national and from plain vanilla to universal. When I say local, it wasn't, of course, the chartered banks that were local. Back in I think it was in the 1850s, there was an act promoting unit banking in this country. Because we had the same populist forces pushing as they had in the U.S. So you had a bunch of unit banks. There were about 200 of them at the time of Confederation. You had a bunch of unit banks alongside the chartered banks. They didn't survive, and by about 1920, they were all gone. But the industry could say it did start out maybe as local. I think the big picture is that from 1867 to the turn of the millennium, and I'm talking about this millennium, I'm not talking about 1900, the banks and their shareholders have been on a bit of a charmed journey. They went from bare bones infrastructure and very few customers, very small population at the time of Confederation, to the current network of 6,200 branches, and it was higher at one point. When I was at the Bankers Association, I think it got up to 8,000 or something like that. And of course, there's the 18,000 ABM machines. So that was a huge journey and a hugely profitable journey when you think about what it allowed them to do off of core administrative infrastructure, add these units as the population and the business potential in each community materialized, and it did lead to superior shareholder returns through that period. So there were about three dozen banks at Confederation. It went up maybe to about 51 in the 1870s, and then back down to 3 dozen in 1900. So about the same numbers at Confederation, but the real story is that the branches off an increasing population and the need for core infrastructure had grown from 120 to 450 by about 1900, and then from to about 4,600 in 1920. So huge growth, and again, huge bottom line potential. And in fact, there's this wonderful piece of work by the Federal Reserve of St. Louis. And I don't know if they're quoting, it's in 1910, Robert, and I don't know if they're quoting Adam Short or if it's his work.
1910?
Yeah.
Federal Reserve Bank of St. Louis?
Didn't exist? Mm-hmm. Well, I'll have to show it to you, show you what I'm looking at. So what their number is that between 1889 to 1908, the number of inhabitants in Canada per branch went from 11,700, that would be in 89, to 1 per 3,000 in 1908. The number of banks actually then, through the early part of the 20th century, it went up and down. There were a lot of startups. There were a lot of failures. And by the time of the First World War, really, they were down to about 10. And down to about 10 sometime they started to decline in absolute terms in the 1930s. You had about 10 and you had 5 significant banks. So you had, to all intents and purposes, by the time of the Depression, you had a structure, an oligopolistic structure, which is pretty well the same as it is today. And so during that period, not surprisingly, there was not a whole lot of motivation to innovate, and the industry didn't innovate. You took deposits from the public. There were some savings deposits by the turn of the century, but It was pretty plain vanilla, and you lend it to businesses. And that was all you needed to do during that period of very rapid growth in the actual distribution system. There was a bit of a push for added business powers in the Bank Act revision of 1967, which gave the banks the ability to make mortgage loans pretty well unrestricted. They could make some before, and to make consumer loans because they'd taken off the interest rate ceiling. And that, of course, coincided with this huge shift in the population, and it led to a massive increase in a massive build-out in consumer lending, the consumer lending side of the bank's balance sheet, both consumer lending and mortgage lending, and it fueled the next couple of decades of growth, that one Bank Act. In 1980, the banks were still living off that loosening of powers, and they actually never asked for securities powers, which was a little surprising when you knew what was happening in the rest of the world, and that the universal bank phenomenon was alive and well and growing through Europe and the United States, even though the United States had the Glass-Steagall Act. So they never asked for securities powers. They didn't want trust powers. They didn't get it. But 3 years into the Bank Act, interestingly, you started to get movement, and it was I was with the Scotia at the time, and I wasn't with the TD, but I was with the CBA. So the first thing I remember is we were asked to present an amicus curia brief for the TD, which had gone into discount brokerage and was being challenged by the Ontario Securities Commission as being outside of its sphere of jurisdiction, and the CBA actually supported that action, and the TD won it. And then I returned to the Scotia, and I had barely returned to the Scotia when the Scotia went to the province of Quebec and said, give us a securities license. We can't get it through the Bank Act, but you can give it to us. And the province of Quebec, that was jockeying for position with Ontario as a jurisdiction that would house the banks, said sure. So there was the TD with its discount brokerage. There was Scotia that had just been given the right to form a subsidiary, and the whole house of cards fell down. And by 1987, the Ontario Securities Commission and the federal government agreed not just that the banks should be able to get into securities, but they should be able to own the big securities firms, which is just as well because most of them were in trouble at the time. The country was moving into recession. So I think it was a happy coincidence. And then they were given full trust powers in 1992. And that was significant. It wasn't that they were given the powers, it's that they were allowed to take over the trust companies. So I will come back to that, but let's just go into the not so nice interlude in the 1970s, and that's the interlude that started with the euro-dollar phenomenon. And as everybody knows, it's pretty simple, at least in its bare bones. It's euro-dollar was really sparked firstly by something called Regulation Q in the U.S., which put a cap on interest rates, and by foreign exchange controls in Great Britain. And what it allowed people to do is do U.S. dollar deposits in Europe, in Great Britain for the most part, avoiding the prohibitions in their home jurisdictions. And that led to a huge business, not just in U.S. dollars, but other currencies. It obviously led to trading. It led to swaps because you needed to swap back into your home currency. It led to syndications. There was a big push to place the dollars. And the dollars were so substantial that you were placing them in chunks larger than the chunks that the banks were prepared to tolerate in their own. So they were syndicating a lot of their loan book, and a lot of that book was with sovereign countries, mainly in the less developed world. Some of them were the oil-producing countries, and at least they had a revenue base initially to service the loans, but some of them were just in less developed countries that had no oil, like Brazil. And so it looked all very nice for a while, and the banks grew their global network to service that business. Now, it was really to market to that business. They weren't booking in every one of these sites, but they built scores and scores of representative offices. They were in Asia Pacific, in Europe, in South America, in India, in the Middle East. They were everywhere. And I think in the case of the Royal, they grew their international network from 30 offices to 45, so 50% growth within less than a decade. And so I found this great little book. I don't know if the Royal knows it's on the internet, but it's pretty interesting. And it points out that it quotes an article from Rolly Frazee, who was the chief executive in the 70s, and he says to the New York Times in an interview, he says, everything we do now, we think globally, no matter what type of business we're dealing with. And then the commentator who's writing the book goes on to say the bank's strategy through these years of international growth was to establish little toeholds wherever it could find them, and then hope it could pry these niches open to establish lucrative positions in far-flung markets. And so a little bit of a different view. But initially, there was a lot to sustain the view that these little offices would end up paying for themselves, and because the returns on this wholesale business were phenomenal. The margins may have been low, but you weren't really needing to support them with any bank infrastructure, and there were not any real capital rules at the time. And so in the case of the Royal, for example, the return on international assets in 1984 was 84 cents per $100 of assets, whereas domestically they were earning 50 cents. Oh my God, I'm really over. Okay, so it didn't end well, and the only thing to remember is they all did it differently when they unwound. Most of them ran for cover. The TD liquidated its portfolio as quickly as it could. Others waited until the debts had been renegotiated. Scotia Bank said, we're not liquidating. And everybody thought they were crazy, but ultimately what they did was they funded their entry into Asia and into South America off the debt-to-equity swaps they were able to engineer from these portfolios. So we have the 87 little bang, and to say the least, it produced another big flash of business for the banks domestically and internationally. And the point was it wasn't just domestic, it was international, because for the first time they were able to lever what the securities subsidiaries were doing already. They had been in global markets, and the securities subsidiaries were able to expand on the backs of much bigger capital bases of their parents. So a very, very lucrative period of time. One analyst reminds us that just trading income at one point went from 5% to 10% to 20% of bank revenues between 1989 and 2010. So the point was the music, in terms of added powers, then stopped, and the question became, what do you do next? The big flashpoint was when the federal government turned down bank mergers, TD, CIBC, RBC, Bank of Montreal, and the banks were staring at a world where there would be no more consolidation and there would be no more expansion of powers domestically. And so while they always knew they were going to be moving into, they were going to have to move beyond the Canadian market, this was really a very big point in time. And they did move. Now, the BNS was already there. They had been building their network very steadily through arguably the 80s onwards. But the others, Bank of Montreal had gone into the U.S. with Harris Bank in 84 and kept it. The others tripped many times. They bought, they sold. There's a slew of banks, mainly in the U.S., that the banks did not keep because strategically they realized they weren't going to deliver for them. But today I think it would be fair to say that they're at a point where they all think they found, you never know, they think they found their strategic footing. The BNS is the only one that's not sort of very U.S.-centric. The TD is the most U.S.-centric. And I would say TD and BMO. And the Royal doesn't get a really good shake. People will say the Royal's doesn't have a U.S. strategy. Well, it does now. The Royal is actually a hugely global bank, but it's spread across all their businesses, including their wholesale. And in both their wholesale and in their wealth business, they would be among the top banks in the world. I think top 10 on wholesale and top 5 in the U.S. on wealth management. So I would say it's always we will see because it's early in the journey, but strategically they are now well positioned. I'm almost ready. I'm almost finished. I'd want to just finish with a couple of observations on points of similarity because the strategies themselves are on the face of it so different. I'd say the first point of similarity is that all of the strategies are very shareholder-driven and constrained. So the banks have made an implicit promise over many decades to deliver faster growth in shareholder value than what could be delivered if they just remained in their initial space, initially as unit banks. And they've delivered that. So their move beyond Canada was very, very shareholder-driven. I don't think it was driven by we're now big enough to compete. They probably always were, even though they said they weren't. I was paid to say they weren't. But it was a view that that was the only way they were going to continue to deliver for their shareholders. The challenge now is those were all acquisition-driven strategies, and at some point the acquisitions stop and you become reliant on organic growth. So if you don't deliver at that point, you become shareholder constrained. It's still ahead of us. There's also a common belief across all the banks that there's a need for geographic focus. It didn't seem so in the case of the Scotia for a long time, but they've now pulled back. They've got 4 countries in Latin America that are their main axes of growth, and they pulled back from Asia. They pulled back from a number of their Latin American, and the Caribbean is great business, but there's no growth in the Caribbean. There's belief across all of them that the U.S. offers many years of good growth, but you have to buy big or go home. There's no dabbling in the U.S. market. You get in there and you buy a good franchise, you pay up for it, and you build on it as quickly as you possibly can. And then finally, I would say, notwithstanding all of this global expansion, there's a very strong belief among all of the players that you need to protect your domestic franchise. Global growth is great, but it doesn't give you a license to say we don't need to get it right in Canada. Thank you.